Welcome and good afternoon. Thank you for joining us for the second episode of the RIA Succession Alpha series. You know that as an advisor, you help business owners with succession planning, but you don't apply those same principles to your own firm. And as a result, you feel stuck. You don't know how to bring along the next generation. Valuations make internal successions nearly impossible. Growth is stagnant. That's what this series is going to solve. Over the course of 5 episodes, you'll learn about valuations, M&A, how to evaluate your firm, growth strategies, legal structures, and the internal journey as an owner. I'm Steve Tenney, founder of Grandview & Co. I advise owners of RIAs, helping them to architect their future. A critical element of that is succession planning. Many RIA owners help their clients with succession planning, yet they don't apply that same advice to their largest asset, their own firms. For context, I was an advisor for 31 years. I was a portfolio manager, led business development, and guided some absolutely wonderful clients. I also built, led a CEO, and exited my own RIA. What I learned is that there were things I should have done differently from the start and throughout my time at the firm. That is why I wrote RIA Succession Alpha and launched this series. We'll have 5 conversations with 5 experts who each own a different piece of what it actually takes to realize the value of what you've worked so hard to build. A bit of housekeeping before we launch in. Please enter your questions directly into LinkedIn. This session will last about 35 minutes. I have a feeling it might go a little longer today with Sean. My book, RIA Succession Alpha, is available on Amazon. And later in this episode, I will offer RIA Alpha Index. It's a diagnostic that instantly helps you evaluate where you stand. And welcome, Sean.
Hi there. Good to see you, Steve.
Good to see you as well. Let's start with something a little more personal or a softball. Tell us about something about you that most people don't know.
So here I am kind of situated at the heart of private business, and a lot of people know me as an exit planner and kind of thought leader in that field. But this was not the career that I was planning to pursue. There were 3 that really interested me: professional golfer, concert pianist, or English professor. I don't have any business degrees. I have 2 English degrees, and I thought I was going to go in and get a PhD and then teach somewhere. But I found out there wasn't very much of a job market for that when I was coming out of my graduate program. But I think that there's a lesson maybe for me as well as maybe other people, which is, it's been fun to kind of pursue an unexpected journey. We have to be able to, we have to be curious and open to that. And I think my kind of weird little journey to where I am, taught me that you have to be able to connect the dots in ways that may be surprising, but also it's made me appreciate that business owners go through a weird little journey as they're kind of moving through their business and aging, and then getting to the point where they might be considering some kind of transition. So, I can walk alongside them and kind of appreciate what they're going through.
Yeah, I can relate on the lack of formal business training. I've never taken an accounting class in my life. And
Yeah.
in Atlanta, when we got to recasting earnings, that was a bit of a struggle for me, but I got through it.
Yeah.
So as I mentioned earlier, you work across industries. There's manufacturing, professional services, technology. What do you see RIA owners miss that owners in other industries have already figured out?
I'm not sure figured is maybe the right tense on that. It might be figuring. There's a very active kind of process here for a lot of business owners. When I have seen best in class, I think those owners have really spent years figuring out how to build organizational independence. They've documented processes. They've got leadership below the founder or the owner or owners, right? The partners in a business. And their client relationships really belong to the firm, not to any one individual. So they can be, they're sort of portable, if you will. They can be transferred without disruption and the client doesn't resent it, so on and so forth, right? So there are those dynamics. But let me go a little bit deeper. Here's what good looked like or looks like to me when I see it. First of all, these firms have either leadership teams or owners who are extraordinarily good planners. They can really see long-term. They can see around corners, honestly. And that kind of takes whole brain thinking. I think a lot of people kind of locate themselves on the right side or the left side. But really, at the end of the day, the owners who are at best in class can kind of manage both sides of the brain. And that's not always natural. It may be that they've, like you and I, kind of had to challenge ourselves to develop the other side, right? But that lends itself to really good strategic thinking. One thing that they always do is invest forward, right? So they're not necessarily looking at what's our current EBITDA margin. They're looking at where can I get to in the future if I invest in things today? And people are primarily what they invest in. Their attention to developing human capital is absolutely relentless. That is where they are concentrating their capital today, which makes sense because we know that a lot of a big percentage of any business's value is kind of intangible, and human capital is a big piece of that. So they respect people and knowledge as their most important asset. The funny part of that, I've always said, is knowledge doesn't show up on the balance sheet. People don't show up on the balance sheet anywhere. You can't point to a number that says the value of our knowledge is X, right? So the balance sheet is kind of absent of things that owners will always say count the most. On the other side, what I see is people will say knowledge and people really matter the most to us, and yet they don't invest in their people. They kind of leave them to figure out their own way, which is, you pointed out in your book, kind of endemic to RIAs, where they'll bring in young people and then kind of they've got to find their own way, and they don't, they've got to kind of, eat their own in a way, right, in order to be successful. They manage change very actively. They know that adoption of whatever the knowledge is really counts for a lot, and change resistors and organizations like that are expelled pretty soon after they're hired if they turn out to resist change. So all of that means that they can kind of filter the signal within the noise, right? They can find the signal in the noise. And one thing that I notice is that these leaders say no more often than they say yes. They say no to almost everything. And I don't mean that as a negative, where they're saying no to innovation or anything like that. They're just really good in their strategy at knowing that the essence of strategy is knowing what not to do, right? So they're able, again, filter the signal out of the noise. So they end up with very little dependency at a lot of different levels in the organization, layers. They have written succession and contingency plans, great leadership teams beyond the owner and the leadership team trust one another, and the authority is distributed in the organization. The owner's role has changed and is well defined at that point. They've probably become more of a mentor, someone who can manage missing conversations. They find teachable moments. It kind of goes back to Andy Grove when he was at Intel. He said the job of the CEO is training. That had to be a shock to a lot of people, right? I believe that. I think he's absolutely right. The job of the owner and the job of the CEO is training. the next generation throughout the organization. And that decision architecture is really super clear. The owner doesn't need to make every decision, but they might need to make some. There is an escalation protocol. Yeah. And I don't think those organizations are particularly ego driven. Now, everybody's got ego. You and I were just chatting about it before we came on, but in non-ego driven organizations, the owner is willing to embrace that irrelevance is actually an aspiration, not a bad thing, right? So, and throughout those organizations, what I find is that they really value the outsider. They value the outside or edge case perspective, right? They're inviting people to think differently, to innovate, and they know that they don't have to do it the same way that they've always been doing it. Those are kind of the characteristics of businesses. I don't know if the audience might find something in there that resonates with them, but that's what good looks like to me. And you'll notice I didn't at any point say along the way they make more money or they have higher margins or anything like that. I think the value of the firm rests in those intangibles.
Yeah, I mean, I've been reflecting on what you've been sharing, which has been wonderful, and somewhat on personal experience, and then also in firms that I work with and have exposure to. And a lot of what you describe, I don't think exists in most of the firms, especially when you consider that in terms of quantity, most firms are sort of, I think, the $200 to $800 million range. Once you get into much more professionally led firms, north of $2 billion, then you start getting some of those things. But those belly of the bell curve firms in terms of AUM, they all want to grow. They all have this ambition of getting to $1 billion that's somewhat random. They'd be well served to listen exactly to what you were just saying. So you have categorized people as explorers, pivoters, and triggerers. Can you walk us through each of those?
Yeah, so this is a concept that we came up with in our own strategic planning when we were really trying to segment our marketplace of owners. And, when people would ask us what our ideal client is, at the time, we would answer it in the same way that a lot of other advisors answer it, the size of the business or, a particular industry or whatever it may be, right? And then somehow we stopped that conversation and said, we keep describing the business as our client, and our client is the owner. So what are the human characteristics of our ideal client? And we jumped on the whiteboard and came up pretty quickly with Explorer, Pivoter, and Triggerer. So Explorer are those that are probably pretty early in their process, honestly. They've got quite a bit of runway, potentially before they transition, at least in their own mind, right? So what they're seeking are education, information, insights from qualified advisors, people to talk to, ways to explore, and to kind of locate where they are really through their own self-assessment and self-learning. It can be very self-directed in a way, but the key is that they've got the most runway of all three of them, right? And therefore they have the most optionality. It's good that they're starting early. They're not ready, or in some cases even willing to invest in like advisors to start paying people to move towards some type of transition, but they are intentional about their education, about their learning. Pivoters are kind of the middle group. Their timeline is probably somewhere between 2, 3, 5 years, kind of in that range. So they're a little later to the game. And 5 years sounds like a long time, but it's really not, because there's usually a lot to do. So the pivoter, we call them pivoters because their awareness, in a sense, or their urgency, their sense of urgency has pivoted. If you think about them running at 20 miles an hour on the speedometer, they pivot up to like 60 miles an hour or something like that. It can be quite sudden. There could be a lot of reasons for that. It could be because, one of their peers sold their business, or they were approached by somebody, or whatever, but their urgency and their awareness pivots up, but they still have time. If you ask them, where are you going to plant your flag in terms of time? Because it's really hard to plan well if you don't plant a flag somewhere. There has to be a horizon out there. So if they say, yeah, I'm in that 3 to 5 year range, which we hear a lot, for some reason that's very popular. I don't know why. So 3 to 5 years, then we're going to put them in the pivoter category and explore from there. right? So it might be that that's the wrong category. Maybe there's somewhere else, but it's where we have to start somewhere with the conversation. And we're using time as a tool. Where are they going to put that stake in the ground? And we'll move backwards from there. Triggerers are on a shorter timeline, probably inside 2 years. And that is a run, don't walk, especially if you're going to take your business to market, which basically you have, if you're 2 years away from a planned transition, you have a year to get ready, and then you'll be a year in a process, most likely, right? In an M&A process. That's about what it takes. So triggerers, the optionality is limited at that point, right? They may have eliminated some of these things. For instance, maybe they don't have, because they've waited so long, maybe they don't have an inside, in the RIA world at least, an inside transfer option anymore, right? So now they're kind of forced into an external transaction, which may be good or bad, depending on what they are trying to accomplish. One of the things that we ask in this process is, tell us about the balance in your mind, the importance of liquidity and legacy, right? It's a really interesting conversation to have. Some people will say, oh, 100% liquidity. I don't really care what happens after I transition out of this thing. Some people, and especially family-owned businesses, I think, tilt towards legacy. These things can be balanced. It's not one or the other. They're not mutually exclusive, but it's a good conversation to have. Folks who are on the legacy side are almost always going to prefer the inside transition. And if you look, it's interesting. If you look at the most recent Exit Planning Institute survey on the state of owner readiness for transition, 68% of the respondents across the full spectrum of respondents said that they would prefer to transfer internally, which I thought was very interesting. That's a much higher percentage than it has been in the past. It was a big change. Don't know the reasons necessarily for it, but that was a big change. So you've got explorers who have a long time and they're kind of in a different mindset, not willing to spend money on it yet. You've got pivoters who are now a lot more aware and urgent, but they've got some runway, 3, 4, 5 years, maybe beyond, but they're putting a stake in the ground. And then the triggerers, very short runway, optionality is probably reduced. Not a great place to be. A lot of times triggering happens because somebody has an adverse health diagnosis or maybe an unsolicited offer, family situation, whatever it may be. Woke up one day and said, I'm done. Don't want to do it anymore. Get me out of here. So there can be a lot of reasons for triggering. You work with where you are. Go to the client where they are. That's the whole point of EP&T. Help the client locate themselves. Go to them there.
So everything you just described is incredible advice and perspective for advisors to share with their business owner clients. Going back to the conversation you and I had before we went live was around next gen and ego and trusting and things like that. Is it fair to say that, and I would put that all under people issues. Is it fair to say that if someone is a triggerer, they've got 1 or 2 years maximum for whatever reason, it doesn't make a lot of sense to spend meaningful energy and time on the people issues? Is that a fair statement? Because that's just not enough time to really develop people.
I think it's always worth spending time on people.
Okay.
That's what it comes down for me. The action is in the human capital as far as I'm concerned, especially in professional services businesses like RIA. Look, if let's say an outside buyer is looking at an RIA, right? What are they going to look at? First of all, there's kind of table stakes. Is it making money? Is it kind of in the zone that, does it fit the profile of a company that we want to buy? Size, profitability, location, quality of the customer base, whatever it means. Is it accretive at the end of the day to our strategy as a buyer? Is it accretive? So that's kind of table stakes. You're either going to get through that hurdle or not get through it, but it's an early stage conversation, qualifying or disqualifying. So then where's the buyer going to go? What am I looking for? If I put myself in the outsider's perspective and I'm looking at the business through the eyes of a buyer, I'm going to go to people and culture next. Why? One, those are the things that build the durability of the firm over a longer period of time. I'm not investing in current benefits. I have to pay for the current benefits. I'm investing in future benefit streams. So I have to know that I'm going to be able to grow it. It's going to be stable. It's going to be a durable culture, a durable team, a good team, right? That's done the work up to that point. Are your options for increasing human capital going to be limited because of the time? Yeah, absolutely they are, which is my point. If you wait to work on these things until you're inside that trigger zone, you've waited too long and your options are going to be limited. So you do what you can. But I don't think that I would say don't work on the people, because that's step one after qualifying that the business actually has tangible characteristics that we might be interested in acquiring.
Okay.
There is no future benefit stream if there are problems with the people and culture.
I just want to take a quick pause here and share with people the tool that I made, RIA Alpha Index, that helps RIAs figure out where they are, gives instant results, and also share your email, Sean at Ready for Next USA. So we were just talking about how things look from the other side, and you have a great tool called the Shark Tank methodology. I'd love for you to dive into that.
Yeah, I really like this tool. As a matter of fact, it's a whole lot of fun for everybody, I think. So, it's very similar to the TV show in a sense, but what we are doing in a Shark Tank is bringing in outside professionals of various kinds who will sit on a panel, if you will. And the charge to the leadership team, not to the owner, but the leadership team or the key influencers in the organization, is to present a business case, an investment case, basically, to that panel of people. So the panel might have an M&A advisor, a financial advisor, whatever interdisciplinary configuration might seem appropriate for the situation. We tend to kind of pick and choose a little bit on the configuration of the panel based on the situation, right? So it's a little bit customized, but it's a pretty simple process. When you begin, the first thing we say is, owner, you're no longer part of this process. So you have to sit on the sidelines. We don't even want you in the meetings where your leadership team, the presenters of the business case, are working on the business case and how they're going to present it, because they will be the ones who actually have this conversation. You can be in the room for that, but you're sitting on the sideline. You're watching. So literally they become a sort of a surprised observer of what's going on in the room, right? So now a little bit of the emotion is taken out of it. They're not on the panel, but they're kind of panel adjacent in a way. But what's being tested is the next generation of management or leadership in the organization against professionals who are very experienced in walking through this type of transaction, right? The assumption is they're going to sell the business to outsiders. That's just kind of the sort of, use case, if you will, that we go in. Because we always said, look, if you can build the business so that it passes the private equity investment test, that level of scrutiny, then you're going to be fine no matter what you do. Yeah. So we'll often have on the panel a private equity investor who's looking at it from that perspective. And I'm telling you, they're strict. They're not mean, but they have a certain level of expectation that they're going to apply to the situation. So leadership gets ready. They come in, they make about a 30 to 45 minute presentation. Typically, we want to hear from each of the leadership team or key influencers, so they each take a piece of the conversation. Once they're done, take a little break. The panel will come back, give them some feedback. We'll break for lunch. Then we'll bring them back and we'll say, let's take another run at this presentation. Let's use this time to actually improve it based on the feedback from the panel. What's happening? You're taking a lot of emotion out of the process. You're just hearing it from the outsider in a very constructive and fair way. We're not trying to demoralize anybody. We're trying to arm them with skills and perspective that they can really carry into the future. Even if they're not thinking about going down the transaction, selling it to an outside party road, this helps them run their business better at the end of the day, right? They're making a business case. The business case has either been accepted or questioned. It's been reshaped through these conversations. They've gotten to know people who do this all day long, time after time after time, what they're looking for, what they would consider to be strengths and weaknesses, how things are evaluated. It becomes very, very real. I've also seen situations where the owner, going back to your sort of comment about trust, when the owner sees their team in action doing this difficult thing, which can be a little nerve-wracking, not knowing what's coming, not having seen them do it, and they do it really well, the owner kind of sits back and says, oh, I guess they're more ready than I thought they were, which breeds trust, which helps with that transition of authority and knowledge and things that are so important to setting the next generation, family or not, the next generation up for success.
So you just did a beautiful job describing a big theme in my book, which is do it anyway. There's very, very little difference between great succession planning and great business planning. It's not, you don't get the transaction, but everything else is pretty much the same. So I love that example. There's a lot that goes on with transitions. In your experience, where do owners most commonly fail during this transition process?
There's a concept in the exit planning community. It's not really a concept, it's a metaphor, and we use it as a framework. It's really effective, called 3 legs of the stool, right? So we have the not in no particular order of importance, optimizing the value of the business, doing all of the things that we're talking about today. I would like our clients to always see it through the eyes of an investor. It's an important shift. Light bulbs go up when they go off, when they're starting to think that way. So it's positive. So we're optimizing the value of the business. We're doing the financial planning, the financial readiness for the owner. So that includes not just the financial aspects, but estate and tax and things like that. You can begin to see we're not going to do that. We're business advisors. So there needs to be a financial advisor and estate and tax attorney. Now there are starting to be multiple people around this table surrounding the owner and their other stakeholders. And the 3rd leg of the stool is personal readiness. Am I personally ready to make a transition, right? So is the business attractive to an outside buyer or investor, preferably private equity hurdle? And then am I personally ready, right? Is the business ready? Am I personally ready to go through this process? Do I have what I would call a life after business plan, right? So that particular leg of the stool, I think, is one place where the process will often fail, right? It's kind of a failure point. It's a weak point for sure. It's a pressure point. And when that doesn't exist, there's just very little clarity, I think, for the owner, comfort in a way that they can let go, right? And part of that is just a legacy consideration, but part of it, I think, is just kind of fear of what's on the other side, right? I've been an entrepreneur, I've been a business owner. This is how I talk about myself a lot of the time. We don't want that. We want to have a balanced life, but let's face it, even those of us who, I own businesses, but those of us who don't own businesses, we're spending 40 or 50 hours a week of our life, sometimes much more, doing work in our businesses. There's no way that we don't formulate a strong identity around that. And then owners who sell, it's kind of like my bank account got bigger and my world got smaller at the same time. So now I'm facing I could face an identity crisis if I haven't done the planning. But a lot of people fall short on that one too, I think, because they're trying to figure out what they're going to do with their time. And it's not about what you're going to do. You'll figure that out as you go. You need to kind of rest a little bit first, right? But you'll figure out how to manage your time effectively. It's who you're going to be that counts, right? If you're not this owner anymore, who are you going to be? Are you going to be an investor, a philanthropist, going to do something else with meaning and purpose, right? Hopefully you've done that work naturally in your life prior to the time that you kind of are looking at this identity shift. But without a balance between those 3 legs of the stool, obviously the stool gets wobbly, might even fall over. This is not the owner's failure alone. It is potentially a failure of the process, right? So it could be a process and planning failure. But I also think that we need to be honest as advisors that part of this is on us. If it gets to that point If we are at the closing table, having done a good job of optimizing the business, and maybe there's a financial plan in place and the estate and tax planning is good and solid, and we're at the table and someone still doesn't have a personal plan that they can believe in and be excited about, then we've missed it.
Right.
We've just missed the target. I don't care how much money is about to change hands. Really, at the end of the day, the stuff that counts the most is not there. And that's as much on us as an advisory team as it is on the owner. Now, I will say that I've had some clients who are 100% resistant to the idea of planning for life after business. Part of that is fear-based, right? So it could be ego-driven, it could be fear-based, whatever is doing it, it is in the heart, not the mind. So, it can be a tough conversation to have, and they might say something like, just get me the money and I'll figure that out later. At which point we say, no, that's not the way this works. We need people at the table who can help you through that. This is, it can end up in some bad places. By the way, I've seen exited owners slide into, poor relationships, divorce, alcoholism, substance abuse, isolation, just pretty bad spots. Some, do okay, but probably not as well as they might have if they just done the plan.
I believe the statistic that EPI talks about is 75% of owners after a year regret selling, which is really kind of sad. And, I had an email exchange with someone today who's a buyer. He wants to own an RIA. He had an LOI that fell apart. And then a few months later, very recently, they renegotiated the LOI. Everything's fine. And it was days before the closing and it failed. And so unfortunately now the seller is viewed as being unreliable.
That's right.
Which is unfortunate, because I'm sure they're a reliable person. They run a great business, but they just it jumps off the page. They just did not have personal readiness.
That's right. That's right.
So I want to change gears, change angles just a little bit here, because you interact with a lot of financial advisors who do or want to get engaged in exit planning. Let's say, and I come across people all the time that view it as a great business opportunity for their advisory firm.
Yeah.
Let's say a financial advisor corners you and says, hey, I really want to get into this. I believe in it. Where do I go? What do I do? What do you say?
The first thing we have to do is break the cycle of transactional thinking. So one thing that we want to test and be honest with ourselves about as financial advisors is, what are our motivations for doing the exit planning work, right? So let's be honest. One advantage in the way that we want to see this play out, if we are a financial advisor, is assets under management. This strange, highly liquid, mega liquid stock that we're dealing with in a business is very, very difficult to harvest. It's difficult to prepare and monetize. So financial advisors, especially in big institutions, don't get paid to deal with that asset. So in many cases, we know it's there. We put it in the corner. We pull a potted plant in front of it. So we're aware, but we're not, well, we'll get to it later, right? It's there. It's on the pie chart somewhere. We're not sure what to do with it. We may not even have a value on the business. So we're just kind of plugging a number in sometimes. So we have to break this cycle of, if I talk to owners and this is successful, then I get assets under management. That's transactional thinking. Exit planning is a process. It's not an event. That's not what we're driving toward. You can't do three legs of the stool planning and help the owner in that holistic way, whole brain thinking, in other words, if you are just thinking transactionally. This process is transformational. That's where we have to aim as a team, by the way. So one thing I would say is, please don't try to do this yourself. I would never try to do it myself. It's a team approach. We absolutely focus and just hammer away on that in the SEPA program. But even coming out of the SEPA program, I see a lot of people try to do as much of it as they can themselves before they actually bring other people in. That's not where we should be. We should be bringing the team to the table as soon as possible and understanding how we fit together, what the DNA of that team is going to be, how we're going to work together, what the plan is, so on and so forth. I would also say that you have to go beyond owner, right? So an owner is a person. A person may be part of a family, right? They're part, we've got all of these sort of social networks, if you will, that we are part of, and we are fully that person. We are not just an owner. So often I'll hear anybody who's trying to get in the business that I want to work with business owners. I would prefer that they say, I want to work with people who happen to own a business, and we'll figure out exactly what that looks like, right? We don't, we when we refer to family-owned businesses, we call it families in business, right? Because the family actually is what we're working with. The business is simply an investment asset in one way or another. They just spend a lot of time with it, right? In order to do this work, you have to really be able to connect dots. You have to be very good at pattern recognition, in a sense. Again, whole brain thinking. I think you're going to have to synthesize business, personal, financial information at a level that maybe you haven't dealt with before. Big document sets, many, many data points, some missing pieces that you're trying to fill in order to make sense of it. So, and then I would say interviewing skills are really, really important. The whole thing, in a way, may turn on your ability to have an interesting, authentic, curious conversation with the owner that they walk away thinking, oh, that was really interesting. I've never had that kind of conversation before. I've never been asked those questions before. So I'm always saying, become a really good interviewer, practice that, be interesting, right? Think of yourself as a conversationalist. And sometimes you have to say things that may be a little bit controversial. You may have to ask hard questions, but ask them in a way that the owner will lean into rather than feeling like they need to be, defensive about it. One piece here, so Dennis Jaffe is a really, really well-known family business advisor. He's a professor. He's written lots of books on family business. He's still active today, and he works with really big, complex families. And where I used to live in San Francisco, he and his wife also lived there. And I was talking to her one day over dinner or something like that. And I said, I'm really frustrated. I'm having trouble getting owners, listen to the language, getting owners to get interested in exit planning. I can't quite land it, right? I can't land this plane. And she said, well, I think you have to connect before content. That's what you ought to be. You have to connect before the content. So many times you're going to identify with this, Steve. So let's say that I'm an RIA and I've landed a meeting with a business owner. They're an exciting prospect or even an existing client, right? And I want to tell them all about what I can do for them on the exit planning side, right? And so let's say it's a prospect. I don't have very much of a relationship with them yet. But they've agreed to a meeting, and they walk into my conference room, and placed on the table are my brochures and other collateral, right? That indicate immediately, I'm not really going to listen to or talk about the owner. I'm intending to talk about myself and our services. I'm not going to connect. I'm going to offer content. I'm going to tell them what we can do for them. But I'm going to really, all that is a pretty, one-sided conversation, let's say. It could even be read as selfish. The owner has limited time. They're really not interested in what you do in the beginning. They're interested in, can you listen? Will you help me understand, right? What's going on? Can we work together? So those are important for me. Those have been lessons throughout my career. I've been doing this a long time, 25 years with business owners. I've advised a lot of people. And I just keep saying to myself, anytime I'm going into a meeting, or even when I'm thinking about marketing to a group of business owners or speaking at a conference, taking a stage in front of them, how am I going to connect with them before I start offering content about myself? And my lesson really over and over again has been, I don't need to offer content about myself. I need to build trust in various ways that are very much in the heart, not the mind. I need to do that first. And then the owner will tell me whether they want to know something more about me.
That was brilliant, Sean. And I completely agree. I would add one thing in the beginning, and that is to go out and learn, to go talk to attorneys, accountants, other advisors. Go talk to business owners. Go to the chamber. Go to the business forums, and just say, "Look, I'd love to get your advice. I'm trying to learn more about the dynamics of people who are in business, using your term." And everyone is willing to give advice. They love to give advice.
That's very true.
And building that knowledge base then allows the advisor to go have those conversations with the business owner and build that relationship. I completely agree. Last question in just, let's say, a minute or two, if you can. How do you help advisors with their business owner clients? Tell us about your work. How would people engage with you?
Yeah. Well, we're right down the middle of the fairway, business advisors, right? So we are one seat in the interdisciplinary group around the table for business owners. And the way that we work together, right, is the RIA, the financial advisor, is we're going to work closely together and cross-pollinate, right? In many ways, people ask, when am I supposed to bring you into these conversations as a value growth advisor? When should we be talking to the owner? And I'll say now, right in the beginning is when we need to be talking. Why? Because we want to show 3 legs of the stool and holistic thinking and planning in action, right in front of the business owner as they are sitting there, because that makes it real. So we can learn from one another through that process. We can be both engaged with one another and jointly with the business owner in a really interesting conversation. Every time I sit with a financial advisor talking to an owner, I learn something, and I'm putting in my pocket saying, okay, that's going to be interesting. I'll be able to use that in the future to improve my performance. Same thing is going to happen for the financial advisor or the state tax lawyer. I just did a workshop for a business owner. I would call it a 3 legs of the stool workshop, very classic SEPA stuff for a business owner who had 17 entities, 17, some partnerships, some single, owned 100% of them. We got his estate tax lawyer and corporate lawyer, one person, his longtime outside CPA, and his financial advisor, wealth strategist, wealth advisor, in the room together. They had never had the opportunity to sort of sit down and talk about all these things together. What came out of it was extraordinary, I think. Not patting myself on the back, I'm patting them on the back, quite frankly, because they really engaged. So did the owner. And at the end of that, we had identified both business and personal areas where we could see that there were ways to just improve, right? We could implement strategies that would make his life better, his businesses better, his family better. We had design pathways for his kids, 2 boys, one in the business, one not. We had figured out how to be fair with his assets if something happened to me or to him or his wife. At the end of the day, just a simple restructuring of the equity, the way that he held equity in these businesses saved him about $30 million in estate taxes. He was 100% exposed. At the end of that meeting, it was fascinating. It was 2 days, really positive. Again, huge preparation, by the way. We reviewed 180 documents. We looked at all kinds of things, produced a lot of stuff for use in the meeting. And then the CPA at the end of the workshop said, John, with the owner's name, John, I don't know what you paid for this, but you got your money back 1,000 times over. And that's just about the right math, by the way. Yeah. So to have the attorney say that, to have them engage, the accountant say that, and for everybody to agree, tells me that the best way to learn to do this and to continue to improve our practices is to be in the room together, each of us kind of wrapping a warm blanket around the owner and all of the other stakeholders with one thing in mind. It's not about us. It's about designing and producing outcomes that help the owner be more successful in what is typically a process they have never been through before and must go well for them to be able to live their life the way that they want to now and into the future.
That is outstanding. So people can see your email right here. And remember, I've got the RIA Alpha Index at riaalphaindex.grandviewandco.com. It's a free diagnostic. Next week on Wednesday, we will be talking with Richard Chen, who's an amazing attorney specializing in the RIA market. If people don't follow him on LinkedIn, they really should. He's quite prolific and has a lot of great advice. And that is my contact information. So Sean, thank you so much. It's been a pleasure talking.
Thank you, Steve. Good to see you.
All right. Have a great day.
Thank you.